Morning, everybody. I hope everybody can hear me. We're going to give it another minute or so before we get started because I can see that lots of people are still joining. So we'll just stay here on the cover slide for another minute or so as people are joining in. Okay, so I think we'll get started. Good morning, everybody. Thank you for joining us and for making the time to attend this webinar. My name is Abdullah Mutawa. I'm the head of the Corporate and Commercial Department at Al Tamimi. My colleague Shiraz Khan, who heads our taxation practice, is also on the line. If we can start with a couple of housekeeping points. As I'm sure you will all expect, we will have everybody on mute to avoid echoes on the line. However, our intention is that this should be an interactive session. So if you'd like to interrupt to ask a question, please do feel free to do that. Alternatively, you can use the questions tab on the dashboard of the GoToWebinar control panel. So you can actually type your questions in there, and then as we see them, we will try to address them, and we'll try and get to all questions during this session. But if you'd like to speak to us, please just feel free to take yourself off mute. If you are going to do that, please, if you could identify yourself, identify your organization, and then once you've finished asking your question, if you could please make sure to put yourself back on mute, that would be very helpful. Just so that you're aware, there is a URL on the bottom of this title slide, which is a web address for our Coronavirus Insights webpage. We've got a page on our website with lots of information on there in a range of different, both practice areas, but also geographic specific information. So it's a good page of resources. And in fact, a recording of today's webinar will be available on that page probably by Sunday or close of business on Sunday, if anybody is interested to revisit that. So getting started, as I said, my name is Abdullah Mutawa. I'm the head of the corporate commercial practice at Al Tamimi. I'm an English qualified lawyer. I've been working as a corporate finance lawyer for about 25 years now. And my main areas of focus are private equity, M&A, and venture capital. But I've done a lot of work in corporate restructuring and crisis management and advisory work over the years. The corporate team here at the firm is nearly 100 lawyers, and we are spread out across all 9 of the Al Tamimi jurisdictions, being the whole of the GCC, plus Jordan and Egypt, Jordan, Egypt, and Iraq. So, Shiraz, do you want to introduce yourself?
Thanks, Abdullah. Good morning, everyone. My name is Shiraz Khan. I'm the head of tax at Al Tamimi across the region in the Middle East. Prior to joining Al Tamimi, I was the global head of tax at a large multinational over 100 countries, where I was responsible for corporate tax, VAT, and customs. I have around 18 years of international tax experience now, having qualified as a barrister in the UK. I'll hand you back over to Abdullah, who will take you through the introduction before I give you some tax-specific input.
Thank you very much, Shiraz. So, look, jumping straight in, I mean, we're entering week 4, I think, of lockdown, or we're coming to the end of week 4, actually, of the lockdown and working from home protocols. I think many of us now are beginning to get tired by endless Zoom calls and conference calls and webinars and online meetings. So the aim today is to try and keep it relatively light. We're going to try and avoid burdening you with lots of dry law, but hopefully what we will do is provide you with some useful insights and practical suggestions. The reason Shiraz and I thought it'd be a good idea to host this session today is that, you know, he and I, Shiraz and I, along with many of our colleagues from our employment law department, our banking department, litigation, real estate, all of our practices really, we have found ourselves at the front line of dealing with the concerns of business leaders across the region, I guess is one way to put it. And through all of the conversations that we've been having with our clients, we've been really getting a lot of insight into what has been keeping people up at night. And you know, our clients range from regional conglomerates and family-owned enterprises, multinational corporations from all over the world, Europe, the US, many from the Far East and China in particular, energy, industrial, utility companies. Lots of our clients are in the banking and financial institution space. And also we've been helping a lot of clients in the services industry space as well, meaning law firms, consulting firms, accounting firms, and so on. So jumping straight into it, I mean, we thought it would be interesting just to share, and I guess what's on this slide here is not going to come as a huge surprise to many of you now that we're 4 weeks in. But in this sort of 4-week, 5-week dealing with the crisis phase, what we've seen is business leaders, CEOs, CFOs, chief operating officers getting into triage mode and managing the sudden change that has happened. The sudden change involving either social distancing and lockdown, or a drastic drop in revenues being generated from the traditional customer base, interruptions to supply chains, lots of different things that are going on. But the key objective and priority for everyone across industry and the business community has been cash management and cash preservation. So that's really what sort of made us think about running this session today, because lots of things are going on. Obviously, businesses are focusing on their workforces, whether they can rationalize, whether they can furlough people, whether they can optimize their payrolls, whether they can use unpaid leave, lots of different things that that companies are looking at. They're also looking at their contractual obligations, whether or not they can delay performance or actually terminate contracts, whether force majeure clauses apply to them or not. And you know, we've been helping them analyze those. And of course, also in the realm of cash and cash preservation, obviously a lot of businesses thinking about their debt facilities, thinking about whether or not they need to seek payment windows, payment holidays, whether they need to see restructuring of some of their debt, and in some cases, in many cases actually, trying to manage issues around solvency. And of course, all of these points are interrelated. So this is just an insight into really the key things that have been keeping us busy with clients for the last 4 weeks. What has been emerging in the last week or so, I would say, is a slightly different discussion. And it's encouraging to see this. I think, you know, one thing that we have also observed, and all of us sitting at home and working from home have observed this, just because we're ordering groceries at home now, we are using e-commerce more, where probably some people have visited with doctors online using telemedicine services. Lots of things have changed and we've sort of been forced into it. But for many businesses, you know, part of building resilience is understanding how to adapt the business model, how to adapt the way in which you operate to sort of meet the challenges. And of course, a lot of the people who are forcing that introspection and analysis are the disruptors. And in the technology space, there are many companies that are coming and have come to sort of disrupt the way in which goods are bought and sold and services are delivered and so forth. So a lot of the discussions, and I get involved in at least one webinar or investor presentation, at least one a week for the last 4 weeks. Actually, it's been more like 2 or 3. And in most of these discussions, this is what business leaders are now beginning to talk about, understanding how the future is going to be different, thinking about what is going to change permanently and what's going to go back to normal. And a lot of people are now thinking about, their capex, their opex, the decisions around, what they spend their money on, what's actually necessary as opposed to what used to be perceived as necessary. So there are some really interesting conversations and decisions going on in that space at the moment. And of course, a lot of that is involving companies preparing to invest in tools to help them adapt, but also to help them be resilient as they move out of the crisis and moving forward. The other thing that I think has been really interesting to watch, not just in the region, but around the world, is the way that governments have stepped in, not just to help manage the public health crisis and the public health requirements around managing the crisis. And certainly, I mean, through our corporate and our healthcare practices, we've also been very, very heavily involved in what governments are doing around the region in terms of developing testing facilities, rapidly deploying, even getting multinational companies involved in, say, manufacturing in one vertical in the Middle East to actually changing their operations rapidly to adapt to the production of necessary equipment for managing the COVID-19 crisis. So, companies from the US or from Europe, for example, that are manufacturing something in the sort of industry or consumer space, now manufacturing masks, N95 masks, or managing other protective equipment, or even some ventilator production. So some quite interesting, stepping up by governments to kind of get involved in managing the public health side. But in addition to that, and in the same way that this has happened all over Europe and the US and in Asia, the governments have been stepping forward with economic stimulus packages to keep their economies healthy, or at least afloat, I should say. And it probably also is no surprise to many of the people on this call that a very significant portion of the GDP of the regional economies comes from the SME sector. The SME sector is particularly vulnerable to the crisis that is going on right now. Obviously, lots of players in the retail space, in the hospitality and travel space have been hit very, very hard. And so, a lot of these packages, and I've just put on the slide here what, at the last count, the governments of the region have done. They've put forward a total of about $140 billion worth of stimulus. And the shape that is taking is, funds to inject liquidity into credit markets, central banks actually getting involved in supporting SMEs through measures like credit guarantee programs, relaxing the credit risk criteria for banks lending, increasing financing ratios for banks in terms of their regulatory guidance. But also we're seeing governments introduce utility and municipality fee subsidies and exemptions, the postponement of tax payments, or the deferral of tax submission dates. And Shiraz is going to go into the tax side of this shortly. And also very significantly payroll support schemes. And again, we've seen payroll support happening all over the world. And in the region here, there have been 2 or 3 really interesting and pretty significant payroll support schemes rolled out as well, which generally are being applied to nationals of those countries, but nevertheless salaries are being underwritten to some degree by 2 or 3 of the governments around the region. So, I mean, if there's a demand for a deeper dive into this particular topic, we'd be happy to arrange another session to talk about it. But I just thought it'd be useful to kind of highlight the fact that governments are, have obviously been getting involved in the way that I've been describing. And now really to move on to the main part of our presentation today, and in the overall topic of cash management, cash preservation, we thought it would be really valuable to get Shiraz talking to you about what's happening specifically in the tax sphere around the region. So with that, I'm going to hand over to Shiraz, and you should please feel free, as I mentioned, to raise questions through the dashboard or to unmute yourself and interrupt us, and we'll try and deal with any questions that arise. Shiraz, over to you.
Thank you, Abdullah. I've been speaking to a lot of clients over the past few weeks, and I think a lot of the clients that are fed back to me, there's three main areas which they're concerned with. The first one is key tax considerations related to COVID-19. The second one is what measures are countries taking in response to COVID-19 across the region. And the third one, which is critically important, is managing the tax risk and maximizing the cash flow. So that's why I don't have very many slides. As Abdullah said, the focus is not to go through the law, but to give you some practical suggestions and practical issues which clients are facing based on our discussions with them. So just to go into it, I've been in the region for 10 years now, and I've seen the whole region develop from almost very limited taxes. Of course, in the GCC, historically, it's been associated with no or limited taxes. So the existence of free zones, you've got tax holidays, limited corporate tax in most countries, historically no VAT or sales tax, and obviously no personal income tax. So there's this misconception that the GCC has limited taxes. Obviously, with the introduction of VAT across the GCC, with 3 countries having implemented so far, is changing the whole dynamics. So at this stage where we are, we have 6 GCC countries, 4 of them are fully taxable jurisdictions, and they have been for quite some time. 2 of them have limited taxes, UAE and Bahrain, and out of the 6 GCC countries, 3 have implemented VAT. And in the other 3 jurisdictions we operate, Egypt, Iraq, and Jordan, there's always been a full suite of taxes for quite some time. So just to begin with, I'm going to touch on corporate tax, which everyone's thinking why, because obviously the whole focus is cash flow. But obviously COVID-19 is creating a lot of disruption to businesses across the region. And you might have a situation, for example, that you have directors in another country who typically attend meetings in the region, but they're based in the other country. And due to the lockdown, due to the travel restrictions, they're no longer able to travel here. And similarly, you may have some directors that may have gone on holiday or traveled to their home countries and they can't now come back. Why is this important? Obviously, across the region, we mostly have source-based taxation. So if you generate income in the country, in the region, you're taxable in the region only in respect of that income. Oman's the only exception, which has a residence-based taxation. But most other Western countries have a residence-based taxation, which means that if you're resident in that country, you're taxable on your worldwide income. And there's 2 ways that you could establish residency in the other country. The first one is if you incorporate in that country, and the second one is if effectively your central management and control is in the other country. Now, what is the central management and control? This is typically where the key business decisions are taken by an organization. So it's typically the place where the board meetings happen. So effectively, if you have a situation where your directors are based in another country like the UK, for example, and they can't come back here to have board meetings, they conduct those board meetings in the UK, or otherwise they're stranded in the UK because of the situation, then effectively you've got a situation where you've got a company which is resident here, which is registered here in the Middle East, but essentially it's ending up taxable in the other country on its worldwide income. So obviously this is a risk in terms of whether it's a real risk or not. Obviously other tax jurisdictions may be lenient regarding this because they're aware that COVID-19 is going on. It's created a lot of business disruption. If the board meetings you're holding aren't routine in the other country, then they may make exceptions. Nevertheless, the risk is there and it can be managed. The key is to document your meetings, that they're happening on an exceptional basis, and show the fact that these aren't routine, these are non-routine meetings. The other thing is, if you can somehow limit the participation of the directors which are based in the other country, that would help. Or even better, if you can postpone the board meetings, then that would help as well. So here we're talking about tax residency, as a result of which your organization could be taxable in another country on the worldwide income. So then the second issue which I've mentioned is the creation of a permanent establishment. And again, because of COVID-19, the employees of the organization, may be relocating to another country because there's lots of business disruptions. Maybe employers are asking their employees to go back to their home country, and otherwise maybe the employees are stranded in another country because they went there on a holiday. But regardless, if you send your employees to another country, you could actually create a permanent establishment. Now, a permanent establishment from a corporate tax perspective is a fixed place of business through which you're doing your business. So if you send your employees there, and generally speaking, internationally, it's accepted if you send your people and they're there for more than 183 days, then that could crystallize a permanent establishment. It's not as bad as having tax residency in the other country, because if you have a permanent establishment, you're only taxable on the income generated by that permanent establishment. But it does trigger a host of other issues. So for example, once you have a permanent establishment, then you'd be liable to register for corporate tax in the other country and pay tax on the income of that permanent establishment. And also potentially the employees you have in the other country, they could also be subject to income tax because they're living there, they're based there, obviously depending on the time period. And then there's also a second layer of complexity and compliance where the organization may be responsible for remitting personal tax of that employee to the government over there. Another linked issue is VAT. So once you have a permanent establishment for corporate tax purposes, you have someone on the ground, and depending on how long the situation continues, you may also be liable to register for VAT in the other country and account for VAT. As you can see, it's a very complicated situation. Of course, there are double tax treaties between countries in the region and other countries, but how they work will depend on the specific circumstances. Another linked issue is economic substance. So as you're probably aware, in the UAE and Bahrain, they recently introduced economic substance regulations to comply with some directions from the EU, because EU had previously placed the UAE on a blacklist, and also Bahrain was under the scanner as well. So both these countries decided to fast track economic substance legislation and also to comply with these obligations under the OECD measures. Now, under this economic substance regulations or legislation, if you essentially undertake certain activities which are relevant activities in certain sectors, and if you undertake those activities, you're required to comply with the minimum economic substance level. And why that's relevant here, in the case of directors, you're effectively required to be directed and managed here, which means that under these economic substance regulations, your directors need to conduct board meetings here. Now, if you have directors stranded in other countries who can't come to the UAE or other countries in the region, like Bahrain, which also has economic substance regulations, then you will end up non-compliant with the economic substance regulations. And there's substantial financial penalties. Also, you could get deregistered, and also the tax authorities here could name and shame you and disclose your details to other tax authorities. Another issue which is linked is transfer pricing. So again, it's linked because transfer pricing, if you have significant people functions in other countries, you're effectively required to allocate some profit to the other country, depending on how long the people are there. And also because of the COVID-19 situation, you may have some changes in your business or operating model. Maybe your business line is no longer relevant and you want to discontinue it. Maybe you want to relocate elsewhere. So the whole dynamics of the business model are changing. And as a result of that, you have to revise your transfer pricing policy as well. So that's just on the corporate tax side. And a final point, documentation is very important in terms of documenting the reasons why your directors are in those other countries. the reason why the employees are stranded in that country, and also for economic substance purposes as well. The documentation is key here. Now moving on to VAT. As you know, 3 countries have implemented VAT in the region: Bahrain, Saudi, and the UAE. Now, VAT, as everyone knows, is a tax on the supply of goods and services. As far as businesses are concerned, it's not supposed to be a tax cost to businesses, and it isn't to most of them. However, businesses have to bear the burden of accounting for the VAT to the tax authority. But the idea is they only pay VAT on the difference between the VAT they collect from their customers and the VAT they pay to their suppliers. So essentially, it's tax neutral for them. However, when they're collecting VAT from their customers, they have to pay VAT on the earlier of receiving the payment, completing the services, delivering the goods, or receiving the invoice, or issuing the invoice. So any of these events happen, they have to account for VAT. So if you issue the invoice, you have to account for VAT. You may not have even received the payment. So there's a cash flow issue there. Equally, after the introduction of VAT for the first time, many suppliers, they also have suppliers and they have to pay them. So there's a VAT cost there, which they have to finance. So clearly VAT, although it's not a cost to most businesses, it does give a cash flow issue. That's why it's very, very important to manage that cash flow issue. Now, some of the transactions which may be relevant as a result of COVID-19 for VAT purposes are essentially transactions related to employees. So now everyone's working from home, or at least most organizations are working from home. And obviously this represents a major change in the nature of doing business. So you'll have employees working at home and they're buying some equipment to use in the business, but they're also using it personally. Now, the fact that these employees are based at home doesn't create a VAT liability in itself. However, for example, if the employee is incurring these expenses and then is getting reimbursed by the employer may be interested in recovering the VAT. However, if the employee is also using it for personal use, then there could be some issues. So there has to be some sort of apportionment, and in some countries, maybe the VAT will be denied completely because it requires exclusive business use. So you generally have to document this and keep evidence to substantiate the input tax you've incurred. And you also need the invoice in the employer's name if there isn't any chance of recovery. Because if the invoice isn't in the employer's name, it'd be very difficult to get recovery. In most countries, it's a requirement. The other transaction related to employees which is relevant is, for example, employees that may have bought work laptops at home and they're using those work laptops. And this creates an issue. Again, the employee, maybe they're using the work laptop for work, and they're also using it for personal use as well. And in addition to that, separately, the fact that the employer is providing the laptop to the employee could actually be a supply for VAT purposes, which the employer has to account for VAT on. So that's one issue. Then the other issue is recoverability for the employer if the employee is using it for personal use on the cost that they've incurred. So there's a double layer of complexity here. Now, moving on to the other type of transactions, which I think everyone expects. So obviously, in the case of a slowdown, a lot of businesses have suffered major disruption. Some of them aren't even operational anymore, and they're just not performing an economic activity. So they're in a position where they have to cancel their contracts. And the cancellation of the contracts, there's two sides of it. So if you're actually canceling a contract in itself, that shouldn't be a supply because no supply happens. But there can be issues, for example, where someone has actually paid you to attend an event, for example, they paid a deposit or they've made an advance payment and you're holding on to it. So do you account for VAT on that? So you have to look at the nature of what it is. Is it a deposit? Is it an advance payment? If it's a deposit, it could be outside scope of VAT. On the other hand, if it's an advance payment, you'd have to account for VAT on that. So the other issue is on the output side, which I mentioned. So you may have already received payment and then the cancellation happens, which means that you have to refund the customer. So in that case, you could get an adjustment of the VAT that you've already paid. So that should put you in a tax neutral position ultimately. There's also issues on the input side as well. So you may have incurred some VAT on costs you've incurred for the purpose of that contract, and the VAT recoverability on those costs could actually be restricted. I mean, generally speaking, you should be okay, but there are some question marks. So you have to assess the VAT that you've incurred. Was it in relation to the cancellation of the contracts before they were cancelled? Because then you could demonstrate that they were intended for the purpose of the taxable supply. And the final point on cancellation is that in some cases you might have a cancellation fee or penalty of some sort or fine if you cancel the contract. So you really have to assess what is the nature of that cancellation fee. Is it actually a cancellation fee in return for doing something? Is it a condition of the contract, or is it just a penalty for cancelling the contract? So if it's just a purely a penalty and it's of a punitive nature and it's intended as compensation, that shouldn't be a supply for VAT purposes. On the other hand, if you're doing something in return for it and it's a condition in the contract, you know, which is being pursued, or for example, one of the parties is waiving their rights, that could trigger a supply for VAT purposes. Because if you're waiving your rights or you're foregoing your rights or surrendering your rights, that could be seen as a supply of a service. Now, also customs. Customs is also a big issue when it comes to COVID-19. So a lot of organizations, they may be facing disruption in their supply chains. They may be receiving goods from one origin and they're no longer able to do that. So they have to maneuver their supply chain to manage that. The other issue is once you receive goods, and you may have delays at customs. Obviously, everyone's working remotely, and therefore, you know, there may be some difficulty getting clearance. And again, for customs, you have to pay the customs, you know, at the time of the import. So this could also represent a cash flow issue. Finally, obviously, in this time, a lot of organizations are working remotely. The question is, do they have capacity? Do they have resources to comply with all the taxes across the board? And many countries, and for Saudi, for example, have a full fledged of taxes from corporate tax, withholding tax, VAT, excise tax, and customs. So there's a lot of compliance burden there, and you have to be prepared. Now I'm just going to touch on some of the measures that have taken by tax authorities in the Middle East in relation to COVID-19. And these measures, they're not really a surprise. Globally, tax authorities, there's a trend that they're providing a lot of relief to businesses who are suffering, and they're trying to support the economy by providing incentives. And they fall into various categories. And one may be, for example, deferring the tax filing deadline. Another one could be postponing the actual payments of tax. Another one is removing the advance payments if there are any under the local tax law. Also the reduction of tax rates as well. And this is commonly happening in certain industry sectors, which are either affected by COVID-19, or the idea is to actually promote consumption in these areas because they're important when it comes to COVID-19. For example, the hotel industry, airlines, restaurants, transport sector, tourism sector, and the medical sector. Also, various VAT exemptions, suspensions of tax audits is also happening, accelerated refunds of withholding tax and VAT, waiver of penalties, customs relief as well for essential supplies that you're making. Generally speaking, the direct tax measures are usually limited because a lot of it is to do with cash flow. We've actually been having discussions with some tax authorities across the region. So many of them are still in the process of reacting to what's going on, whereas some of them have reacted, others are waiting. So hopefully there'll be some more news in that area soon. Now, just to move on to the specific measures that countries have introduced inside the actual region. Starting off with the UAE. So the UAE, as you probably know, so far, no VAT measures have been announced. The only measures which have been announced relate to excise tax and customs. So when it comes to excise tax, what's happened is that the UAE has extended the excise tax submission and payment for the month of March for a period of 1 month, which effectively means that the filing and payment deadline for the March and April period is 17 May 2020, meaning that 2 returns are actually required to be filed. On the customs side, the UAE hasn't actually come out with any UAE-specific measures. Dubai Customs has come out with specific measures for customs in Dubai. So one of the measures includes 1% customs duty refund on imported goods sold in Dubai. The other measures involve a cancellation of the bank guarantee, which was usually required to clear the goods, and also a 90% reduction in the customs clearance fees. And also they've generally postponed custom audits for now, given the situation. Bahrain, no specific measures have been announced for VAT, excise tax, or even customs for the time being. However, there was an annual tax filing option, which was available to taxpayers previously, provided that they were resident, they weren't registered as a VAT group, and they made annual supplies of less than 100,000 Bahraini dinars. However, the deadline for this filing application passed on the 29th of March. So you can no longer avail that benefit. In Oman, there's been no excise tax measures. So I'm just flicking through the slides, this is a little slow. In Oman, there's been no excise tax measures. However, for corporate tax, there's an automatic 3-month extension to the corporate tax filing and payment deadline. And this is without penalty. There's also an approval to settle tax via installments and extension for objections against tax assessments, if you can justify the delay at the time you filed the actual objection. From a customs perspective, clearance of goods is available where the importer is unable to produce the necessary documentation. And also there's a waiver on the requirement to obtain a guarantee for the non-submission of original legalized documents. Now moving on to KSA, Saudi's actually introduced a lot of measures, probably across the GCC they've introduced the most, and that's explained by the fact that they have the full suite of taxes as well. So just starting with VAT, they introduced a 3-month extension for the payment and filing of monthly VAT returns for the February, March, and April periods. So essentially now 2 returns are required in July, August, and September, but you can file on time to reduce the burden and pay by the extended deadline to maximize the cash flow. The other things which they've introduced is a 3-month extension for the payment and filing of quarterly VAT return for March period. Also for excise tax, a 3-month extension has been introduced for the payment and filing of excise tax returns related to the March and April period only. For corporate tax also, there's a 3-month extension for the payment and filing of corporate tax and zakat returns up until 30 June from 19 March. There's also an approval of installment payments for zakat and corporate income tax. And now the Gazette are actually issuing automatically corporate income tax and zakat certificates for 2019. And this is generally to allow companies to operate and renew all of their visas, licenses, which they wouldn't otherwise be able to do without that clearance. Also, there's a 3-month extension for corporate tax for the payment and filing of withholding tax returns as well for the months of March, April, and May. I think some of the other good measures that Saudi's introduced is suspension of administrative penalties for late payments, for amendments of tax returns, for non-cooperation, and also for voluntary disclosures. And this is across all taxes, corporate income tax, VAT, excise tax, until 30 June. And on the appeal side, the GSTC has suspended hearing sessions until further notice. So if you have any hearing sessions lined up with the 2 committees, they're on hold at the moment, and they're trying to fill out dates at the moment, and obviously they may be further delayed depending on the situation. I think one other interesting development on the appeal side is that bank and cash guarantees not required until 30 June for objections, so you could submit them without any security. On the import side, there's a postponement of customs duty for 30 days on the import of goods for 3 months against a back guarantee. And VAT on import of goods is also suspended until 30 June, but you have to account for the VAT on the import through the reverse charge mechanism in the return. Gaza have also promised to accelerate tax refunds. So that's on the Saudi side. Now just moving to Qatar. Qatar has not introduced any measures for excise tax. However, in line with the other countries, it's extended the filing deadline for corporate tax returns by 3 months, from the end of April to the end of June. QFC haven't extended it as such, but taxpayers are allowed to apply online for an extension of the filing deadline. Another thing Qatar has done is they've exempted from customs duty imports of certain essential food and medical items for 6 months. Kuwait and Iraq haven't introduced any measures at the moment, but it's possible that they may introduce them in the future. Now, just touching on Egypt and Jordan, Egypt hasn't announced any measures on the extension of the VAT return. However, they require taxpayers to issue electronic invoices and submit invoices with the returns. And there's also no measures on the corporate tax side in terms of the return extension, but individuals' deadline was extended from the end of March to 16 April. There's also some other reliefs in Egypt as well. There's a capital gains tax relief on the disposal of listed securities. And there's also a withholding tax reduction in rate from 10% to 5% on dividends from listed companies. Jordan, which has a full suite of taxes as well. So Jordan, which has a full suite of taxes as well, extended its tax period from January to February to 28th March to 30 April. And it's also got GST on the import of food, medicine, and health-related goods and all local supplies. It's postponed it until the goods are sold, whereas previously you had to account for the GST at the time the contract signed. No corporate tax measures have been introduced in Jordan. However, they're taking a less stringent approach towards customs procedures and inspection formalities on the import of goods. Now, coming on to the final slide, apologies, I had to go through that very quickly. I could have spent a lot of time on it, but hopefully there'll be some time for questions towards the end. Now, I think I've just summarized 10 key sort of action points, or if you like, which are essentially focused on managing the cash flow, staying compliant, and also maximizing reliefs. So these three are very, very key in all these action points. As you can see, a lot of them relate to VAT, and it's not surprising because VAT creates a big cash flow burden. And obviously, if you can manage the burden properly, then it could create a lot of benefit for you. So the first one, maximizing input tax recovery. Clearly, because of COVID-19, businesses have been disrupted, sales have gone down, but at the same time, you may still be paying VAT on your expenses, which you need to recover. So it's key at this stage that you actually receive a tax invoice from your supplier and you process this invoice efficiently. So in the past, a lot of companies, they don't have efficient processes and they receive invoices from the supplier. They hold on to it for months. And therefore, they either miss out on the recovery on time or they recover very, very late. So obviously, if you could streamline that process, make it more efficient, then it could accelerate your VAT recovery. Don't wait to future periods. Ask your supplier to issue your invoice immediately so you could recover. The second point is managing tax refunds on the VAT side and also withholding tax. So you may have other companies, group companies which are resident in other countries, a non-resident in the region, and they may have suffered some withholding tax. Now, it's possible in some countries to obtain relief at source, which means that no withholding tax is deducted and at source. Whereas
Shiraz,
the other option,
I'm not sure if you can hear me, but I think we may have lost sound.
Hi, can you hear me now? Hello? Hello? Can you hear me? Hello?
Yes, Shiraz, we can hear you.
Okay, great. I'll carry on. So there's two common ways you could get withholding tax refunds or relief. One, as I mentioned, was at source, where no withholding tax is deducted, but generally it's unlikely. So most people, withholding tax is deducted and they have to get a refund. But in order to get a refund, the tax authorities do an audit, they assess the whole situation. You have to provide them documentation. You could start this process and have the house in order, all the documents in order. It'll accelerate your VAT withholding tax refund process. And it's the same with VAT. So one way obviously is you could, if you're actually generating revenue and you have output VAT, you could deduct the VAT you've incurred on your expenses against that output VAT. Whereas in situations where you have little output VAT and you have lots of input VAT, or you don't have any output VAT, you're in a refund situation. Again, tax authorities are being very tight in terms of giving refunds at the moment. And obviously they may relax some cases. However, they do a proper diligence and they make sure the documentation is in order. So that means that obviously you need to ensure that you made the payment, you have received the invoice, it's a tax invoice. And also sometimes they ask for invoices on the supply side. So where you've made some supplies, they just want to make sure everything is in order. So just having all this documentation in place and ready could help you quite a lot in terms of VAT efficiencies. The third one is, again, another VAT one. So there are some measures in some tax laws related to bad debt relief. So there's special schemes, and there's also cash accounting schemes, which is available in Saudi. I think it's more limited in UAE and Bahrain. However, in terms of bad debt relief in the UAE, if you have debt outstanding for 6 months, if you write off the debt and you notify the customer of the write-off, you could recover VAT. In KSA in Bahrain, the conditions are a little bit more tighter. Both of them require the debt to be outstanding for 12 months. In Saudi, you have to write it off and also get a certificate from a certified accountant, as well as demonstrate that you've initiated legal proceedings to collect the actual due, and you have to provide evidence of that. In Bahrain as well, similarly to Saudi, is 12-month outstanding the debt needs to be, and you need to take measures to collect. So showing emails and calls that you've made and you haven't been able to collect from your customer, only then you could relief. But these two are good ways to also get some cash flow benefit. The next one's relevant for both VAT and customs. So the first one is amending your contracts to make sure that your payment terms are short, so you receive payment on time. We've already talked about cancellation of contracts, and obviously some of the conditions around that are very, very important. Even in terms of determining what VAT treatment is applicable, because depending on the nature, VAT could be applicable on the cancellation fee or not. And again, for customs purposes, the supply chain is very, very important. As I said, businesses have been disrupted, so you may have previously been receiving supplies from one country and you can no longer receive supplies from that country. So therefore, just making sure that everything is in order. Moving on to the next one, which is also related to VAT, there's some general cash flow planning that you could do when it comes to VAT, which could help you with cash flow benefit. So the first one is invoice timing. So if you generally invoice someone towards the end of your tax period, you have to account for VAT a lot sooner. If you invoice them at the beginning of your tax period, then you have a lot more time to collect the money from them. Also, when it comes to invoice timing, and this is the reverse scenario now, generally speaking, you have to account for VAT when you've completed the service or you've supplied the goods. But for some continuous supplies, you don't have to account for VAT until you receive the payment or you issue the invoice. So what you can potentially do is send an email requesting the payment, or you could have a pro forma invoice, which effectively you issue at the same time you receive the payment. Obviously, this needs to be checked on a country by country basis, but it could work depending on the situation. Another one is extending the tax period. I mean, in Saudi and Bahrain, they're based on supplies, but in the UAE, you could request for a different tax period. And there may be some benefit in having a longer tax period, which obviously it delays your payment to the tax authority. But if you're in a VAT refund position, you don't want that money stuck either. So depending on your situation, which way you're going, you could actually utilize that benefit. Also, VAT grouping, that's a good measure as well. So generally speaking, if you're not a VAT group and you have transactions, that's subject to VAT. Whereas if you have a VAT group, there's no VAT on intergroup transactions. So that's a potential measure you could consider. The next one is customs. So in the GCC, you may be receiving supplies across the GCC, and the way customs works in the GCC, customs only applies at the first point of entry. However, you do need to satisfy some further requirements and conditions and documentational evidence you need to provide in order to benefit from no customs duty on intra-GCC supplies. So it's not automatic, and again, the main thing is to have that documentation in order. Point number 7, again, another customs point. So when it comes to the supply chain, your routes may be disrupted, and you need to check, for example, there may be some free trade agreements in place, like GAFTA, which is a Greater Arab Free Trade Agreement. And under that, there may be some special rates available or even other exemptions. To the contrary, you may previously be benefiting from a GAFTA, and because of the route change, you may no longer benefit from that. So, but again, you have to check the impact and monitor what's going on. The next one, number 8, is managing customs clearance delays. And I think, as I mentioned earlier, a lot of the customs authorities, they're working remotely and they have less people now. So if you can take advantage of pre-clearance, you should do that. Number 9 is avail of tax reliefs and incentives to take advantage of COVID-19 tax measures. So of course, all these governments have introduced all these measures. You may need to satisfy some conditions. So the key thing to do is keep abreast of all these changes and see how you could benefit from these changes and what you need to do to benefit from these changes. In Saudi, there was also a tax amnesty program introduced by the Saudi customs on the 1st of January, where they effectively allow customers or importers a 6-month period until the end of June for correcting errors in import declarations which were incorrect in the past 5 years without penalties. So this is a great scheme, and I think if you can, you should try to benefit from this. And then finally, moving on to number 10, again, looking at all these measures, it's very important to assess the tax impact of your operations, the impact of COVID-19 on your activities, and what tax authorities are doing and how you benefit from this. And the other thing to bear in mind is obviously the fact that all these reliefs are there means that the government's trying to support you, the tax authorities are trying to support you. But by deferring an obligation to pay or file, it doesn't mean that there's no compliance obligation. And also the fact that COVID-19 is happening and the situation in Israel is no excuse either. So if you benefit and avail of a relief, that's fine. However, you have to comply with the extended deadline. And if you don't do that, you'll be non-compliant. So it's very important to manage the risk. And of course, this whole situation is also probably impacting the tax authorities' revenue as well. So in the future, and also with the oil and gas situation, with the oil price really going down, and again, one of the reasons why VAT was introduced was to diversify the economies. And therefore, with obviously the oil and gas price going down, businesses in a major state of disruption, in the future, tax authorities will be seeking to generate more revenue. Obviously, they're trying to help now, given the difficult situation. So that's to be expected after COVID-19. So the important thing is to not fall off the track, stay compliant, and look for the future as well. I think we come on to the Q&A now, so we just have 5 minutes left to take any questions. So there's if you see on the right side, there'll be a questions tab, so feel free to post any questions there, and we'll obviously try to answer what we can. If you can't answer any questions because we don't have time, please feel free to email us, and Abdullah's email is there, as is mine.
Thank you, Shiraz. And just for everybody's benefit, I was told while we were in the middle of our webinar that apparently you're not able to unmute yourself. So I apologize for misleading you at the beginning of the call. I see we've already got 2 or 3 questions in the questions tab. Do you want to try and deal with 1 or 2 of those, Shiraz? And I suggest that we may want others to just submit their questions to us via email, because we really do have to wrap it up at midday. Shiraz, over to you.
Okay, so the first question here is by Osama Martin, and the question is, if the directors of the company stay outside the country, why is it necessary to register the company with the other country's tax net and need to submit their returns if their stay is more than 180 days? Since the company PE should be based on the registration of the company and not with the directors. Okay, so just to answer your question in short, the fact that the directors are based there, if they're there for short term, it shouldn't create any issues. But depending on how long the situation goes, if they routinely start to have meetings in that other country, it could actually mean that the company is actually resident in that other country. It's a different issue to having a permanent establishment. Permanent establishment is having a fixed place of business, whereas your residency is where your key business decisions are taken, your strategic decisions at the highest level. And the difference is, like I explained at the outset, that in the case of your residency being in that other country, you'll be taxable effectively on your worldwide income, depending on the country's taxation system. Whereas for permanent establishment, you're only taxed in respect of the income attributable to that permanent establishment. I hope that answers your question. If it doesn't, please feel free to drop me a line. There's another question here regarding the economic substance regulations, and the question is there any extension of the deadline for mainland companies in the UAE? Actually, no deadline. There's no extension in terms of the requirement to submit the actual report, which is 12 months after the year end. However, I think previously the DIFC announced that you have to make a notification by the end of March, but then the later on retracted that, so that's no longer relevant.
Shiraz, I've just noticed somebody has posted a question asking if we can mail the slides, and just for the person who asked that and for everybody, there is a handouts bar on the dashboard on the control panel. So if you go to handouts, you'll actually be able to download a copy of this presentation immediately right now. Shiraz, do you want to try and deal with one more question before we wrap up?
Okay. There's a question here. You mentioned receivers of Saudi withholding tax. Can you please explain how that applies to consultants? We are a consulting firm of architects. So if you're a non-resident firm of consultants and architects, you're effectively providing consultancy services to Saudi company. And that effectively is Saudi source income and is subject to withholding tax in Saudi, because any payments a Saudi company makes to a non-resident company for services, they're subject to withholding tax in Saudi if they relate to Saudi source income. So that's how you would fall under the Saudi tax net. And therefore withholding tax would be applied in the first instance if you don't receive clearance to receive the payment in advance, which is unlikely in practice, and you'd have to get a refund of that withholding tax from the Saudi tax authorities, which obviously involves a lot of process and also challenges. I think that concludes the presentation because it's 12 o'clock now, so we've just hit the back end of the presentation. So if anyone, like I said, if they have any further questions. Sorry, Abdullah.
No, sorry to interrupt you there. So there are actually lots of questions coming through. I'm afraid I've actually got to jump on another call, and I think Shiraz does as well. So I'm sorry that we've not been able to answer everybody's questions, but as Shiraz said, our email addresses are on the last slide there. So you can feel free to please email us. A recording of this webinar will be on the Coronavirus Insights page of our website. Again, the URL for that is at the bottom of this last slide. So what I will do is just leave the meeting open for another 30 seconds. So if you want to download these slides, you can do that right now by going to the handouts section of the control panel. But then I'm afraid we do have to wrap it up because actually I've got to go straight into another meeting now. Thank you very much to everybody for making the time to attend. Really appreciate you taking time out of your day to listen to us. I do hope that that was useful and provided you with some practical insights. Thank you very much, Shiraz, for a very comprehensive overview of what's happening in the tax regimes around the region. And I do hope that that was value added for our audience. Thank you very much, and we look forward to seeing you at the next Altamimi webinar event.